We are back again, Matt Piepenburg and myself, with another MAMChat. And, we are constantly worrying, Matt, about inflation because, it's virtually not possible to print unlimited amounts of money. And especially if you look at the Austrian school of thinking that inflation is linked to money supply, not to prices as such, but to increase in money supply. And therefore, you cannot print trillions of money without actually affecting inflation. And of course, then we have our old hobby horse, which is negative inflation or negative real yield, actually has a real impact on precious metals prices. So where do you see that we are on real inflation now? Because there are so many measures of real inflation and everybody looks at inflation differently. Real interest rate. I'm talking about everybody. Right. Where are we on real interest rates? And inflation is a major factor of that. And of course, there's so many ways to measure inflation. So where do you see that we are actually on real yields now?
No, it's an important topic to revisit, this idea of inflation outpacing yields, because that's the perfect environment for gold and silver, and gold in particular. And negative real rates is always a tailwind. And we talked about this in a MAMChat a couple months back, just about that understanding that inverse relationship to gold price and negative real rates. And so that involves, when you're looking at negative real rates, you're looking at inflation and you're looking at yields. There are different ways to measure negative real rates. Some folks use the yield on the 10-year Treasury. Some folks use the yield on TIPS or Treasury inflation protected securities. But there's been so much changes in just the last 60 days on inflation projections, and yields on the 10-year that let's just revisit this. And again, keep in mind, to keep it simple, stupid, it's just what's the inflation rate and what's the yield on the 10-year bond. And if the inflation rate is outpacing that yield, that's good for gold. And when it comes to inflation, right now the official CPI index in the U.S. for inflation, which we've written and talked about, is kind of a silly indicator. It's pretty much an open secret that it doesn't really measure inflation, but that hovers around 2.6% now, and there's lots of talk of fear of more inflation. To your point originally, Egon, it really is about money supply. It's not just the Austrian school, it's common sense. You can't add a bucket of water to a glass of wine and keep the flavor of that wine, and you can't add money to the system without diluting the currency or creating inflation. And I wrote recently about the M1 and M2 money supply increase. We've had a 450% year-on-year increase in the M1 supply, a 30% increase in the M2 supply. The Fed, in its infinite wisdom, is doing its best to hide that from the public by no longer producing those numbers every Thursday at 4:30. So, when you don't like your report card, you just hide it. So inflation just on pure money supply metrics is undeniable. In terms of commodity pricing, look, whether it's a 2x4 lumber or copper reaching 10-year highs, or corn, or Bitcoin as they're calling it, look, there's a massive commodity supercycle increase in price right now. That is clearly inflationary. And we talked briefly also about government guarantees of commercial banking, which will increase the circulation money. So these are all undeniable tailwinds for inflation. However that's measured on the CPI scale aside, there's no doubt that we're looking at an inflationary tailwind. Again, now we've looked at the inflation side, again, measured around 2.6. The yield on the 10-year bond is about 1.6. It bounces around, but understand that yields have gone up about 70% this year in the U.S. It's still hovering below 2%, of course, but that's a critical indicator too. If yields rise higher than inflation, that would be a headwind for gold. I don't think that will be the case, but the yields are something we have to really understand. There's a lot of talk about bonds tanking and yields spiking. That's absolutely a valid concern. Certainly in May, there'll be some new direction, but keep in mind the big picture. With $30 trillion in public debt in the U.S., if yields were to get to normal medium ranges of 4 or 5%, the U.S. government simply couldn't pay its debt interest. So my view on yields in the near term is that the government will continue to print money to buy bonds to keep yields artificially repressed. That, again, is a near-term indicator. So I still think inflation will outpace yields. And when we get to a negative 1%, negative 1.5% real adjusted rate, like we saw in August of 2020 when gold hit 2070, that will be a great tailwind for gold down the road and currently. So my view on yields is that the government and the Fed in particular will try to repress them. Egon, you have a different possible view, which I don't disagree with. In fact, ultimately, I think at the end of the day, the Fed loses control, or the central banks lose control of the yield curve. What are your thoughts on that? And kind of walk through what that would look like if the Fed simply couldn't control the yields.
Yes, well, so you're saying that we are around negative yields now on the official on inflation figures of about 1%. I think we are between 0.8 and 1.
Yeah.
And of course, the real inflation is a lot higher. But nevertheless, you remember that I lived through the 70s and we had negative real yields for many years, 7-8 years at least. With much higher interest rates, of course, up in the mid-teens or higher. I believe that now we are going to be not similar to the 70s, but the big problem for the U.S. Fed is that they can't really control the dollar. They can control to some extent short-term interest rates, and they have succeeded so far very well, above my expectations, I must say. But now that they are, the money printing has now gone to an extent that I don't think it'll be possible to control the dollar. They've never been able to. I mean, the last time there was a joint action between all the central banks in the world was a long, long time ago. So that's not happening anymore. And I think that, with that amount of those trillions that the US have now created and printed, not just the Fed, but also the general debt in the US, the ways it has been surged, that will start to impact on the dollar. And it has already. We're down approaching 90 again in the dollar index, and the euro, which is a rubbish currency, looks like it's actually in a very strong uptrend against the dollar. So I see that at some point, and that could be imminent. We had a small correction up in the dollar index now, and it came down 3% immediately. So I could see the dollar index crashing by from 90 to 80 to 70 to 60, etc. And then you will automatically have massive pressure on interest rates. And again, it will be foreigners selling, especially foreigners, but investors in general, selling the longer end of the bond market. Right. And those long yields will eventually pull the short yields up. Now, the Fed will fight with whatever tools they have to keep rates low on the one hand, but on the other hand, when they get this dilemma of the dollar on the one hand and then keeping interest rates low on the other hand, that's an insoluble position they will be in. Yeah. And the dollar will automatically win that race because that's an international currency held by so many, and people will dump dollars. So therefore, I do believe that that's going to come. It might have come in the next 3 months or 6 months, but it's going to come within the next year or whatever. But I think the dollar fall is imminent. It's only the extent and the speed of the fall, in my view. And that will have this impact on this. So that's why I think that's going to basically tip the scale for the whole world economy. I mean, the world can then not sustain. The world can't sustain 1% higher with global debt where it is now. If you talk about then 5% higher or up to 10% and higher where we were in the 70s, then there'll be no chance, of course. So that's the scenario I see, and that worries me considerably because, of course, then you also have a bond market which will crash and a dollar which will crash. And of course, then the stock market will crash then also. And that's going to come at some point. It's only a question of when. Will it be this year or next year? It will come. So the risk is there, and that's what investors should think about. But I mean, you've seen Powell has made now a pronouncement how he's going to solve the debt crisis, to me, I mean, is the wizard of the U.S. now, and I wonder what tricks he has in his bag. What do you think?
Well, I think your concern about the dollar and the bond market is equally shared by Powell. The difference is he can't speak plainly about it. So that corner you said that the world's in, Powell's definitely with his back against that wall. I have to hand it to his ability to spin this. It's quite impressive. And I wrote about that. It'll come out this week. But just last week in Washington, Powell was at an economics club, and they were asking about these questions about debt and rates. And the massive amount of U.S. public debt. And his open admission, which was a half-truth, was he said, yes, we are on an unsustainable path with debt. But that was the truth. Congratulations, Jerome, for telling the truth. But his next sentence was even better. He says, but don't worry. In the near term, we can pay for that. We can cover this debt. I'm not concerned about the debt. And what he means by that, to translate that into basic English, is in the near term, we can print tons and tons of money to keep rates controlled. And what he then said, but of course that's a tailwind for gold and for inflation, but what he said next in the same breath was more astounding. And this is where it really gets dishonest. What he said in the next breath was, yes, it's an unsustainable path. In the near term, we can cover it, but not to worry, because in the distant future, when we have economic growth, we will handle the debt problem then. In other words, can kick the issue. So let's break that down into a reality check. In the distant future, when we have economic growth, but based on David Hume to Joseph Schumpeter to Ludwig von Mises, it's mathematically impossible in the long term or the near term to have economic growth down the road if your debt to GDP passes 100% or your currency's lost 98% of its purchasing power in the last 50 years or 80% in the last 20. So that idea of a distant future where we solve the debt problem is literally fiction. It's literally not true. And so Powell is in a position where he has to pretend and extend and use a good face. I say he's got the face of a circuit judge, but the spin of a circus promoter.
But so, Matt, again, we always fall back on history, because you just look at the history of the U.S. debt from, well, you can start at 1913 when the Fed was created. It's been a one way, hasn't it? That's absolutely, it's. I think since the 1930s, there has been an increase in U.S. debt every year, with a couple of years exception. And as I point out many times, the Clinton years were fake surpluses. The debt went up, although the surplus, they showed a surplus, but that wasn't real. So, the history tells us really where we're going. It's so easy. And now it's going up exponentially.
Yeah, no, it's pretty cyclical from 1929 to 2009. You have debt booms and busts. You try to reduce rates to encourage more debt. You create another boom, and then you create another bust. Now we're in the biggest boom of all. It's an everything bubble. It's not a real estate bubble. It's not a tech bubble. It's an everything bubble. So, yeah, look, it's history, it's math, it's common sense, and it's the Fed stuck in the middle trying to telegraph a positive message. Just to keep this in the good time zone, we've talked a lot about negative real rates, about inflation and how that impacts the gold price. You've written some interesting stuff recently on silver, though, Egon. I thought we'd close with some of your thoughts, because I know a lot of folks are interested in silver in addition to gold for good reason. What's on your radar right now in terms of silver, on your thoughts?
Well, I'm very clear that the potential of silver is massive. With the gold-silver ratio, we've seen it up 130, and now it's come down over 40% from that level. And we are definitely going to see it going down to the level where it was in 2011, which is 30. It went down to 30 in 2011. And of course, the long-term rate, gold-silver ratio, gold divided by silver, is the historical long-term rate is 15. So there's still a long way to go. So that means that silver is going to go up probably 3 times as fast as gold. But we always warn investors it's a very volatile investment, and therefore silver will be absolutely spectacular. At the same time, if you want to sleep well at night, you should hold more physical gold than silver, but hold a good bit of silver also, but because there you're going to see, this is the poor man's gold. A lot of people are going to buy silver. Now, there are a lot of talks about shortages of silver in the market, and there clearly are real shortages, although we just had a survey, a Metal Focus does a gold source and silver survey, and they do it for the World Gold Council in gold. but they have, when everybody talks about a surplus in silver for 2020 of about 80 million ounces. Now, that is an inconsistent way of measuring the silver demand, because they have excluded the silver ETFs. And the silver ETF demand in 2020 was 250 million ounces. No, there was 330 million ounces. So 330 million, and they said there was a surplus, but if you take off the 330, you actually have a negative 250 million silver in 2020. And that means that there is actually, as there has always been, a shortage of silver. Now, even JP Morgan with their SLV ETF is silver. They said that we might not be able to now meet the demand for the SLV shares with physical silver backing, because there isn't enough silver around. So they've changed their prospectus even. So, it's clear that there are massive shortages in the silver market. And of course, now the Reddit group are again going to have an attack on silver. And that's the 1st of May. So, not far away. And that's tomorrow on a Saturday. And I even last time believed that it's a tough battle against all the bullion banks, against the BIS, Bank of International Settlement, Basel. It's going to be difficult to beat them all. But if they catch them on a bad day, and this is the anniversary of a big fall in silver in 2011, so if they do that, they one day they might succeed, but of course if it starts momentum, but they're not going to succeed on day one. But nevertheless, because of the general shortages of physical silver, one day that market will blow up. And that's when gold, silver is now, there's a resistance at $30, and they're trying to hold it there, the bullion banks, below 30. We see every time it comes near there, boom, it goes down a few dollars. But I think that will fail. And once it goes above 30, there's going to be a quick move to $50 in my view. So silver is an exciting investment, but don't look at it as a Reddit group. Don't look at it as speculation, because that's not what it's all about. It's about wealth preservation. And the silver is a very, very good investment, as I said, to hold in addition to your gold for all the risks that we have discussed, and because that debt will blow up one day. And when it does, of course, there will be no real price of precious metals at all. Supply
and demand will actually come back into its natural element instead of being manipulated by BIS and bullion banks and primary dealers on the Forex exchange trying to push down what is supposed to be capitalism, though. That's supposed to be natural supply, natural demand. It's amazing how they can omit and add where they want to manipulate the price. But, again, eventually debt and supply and demand went out over intervention.
And of course, as we know, there's so much paper, gold and silver issued. So there won't be enough supply. So there will be no supply, basically. And when there is no supply and very high demand, what happens to price. There will be no price. So that's a market that, this is not sensational. This is real. It's going to happen. But again, we're worried about risk, not actually the sensational or speculative aspect of it. Just hold your silver and your gold and protect yourself. That's what it's all about.
Absolutely.
Course, the other thing is that we're seeing now, just briefly, is the stock market. The stock market is nearing a top. They can last for another 3 months or whatever, because you're at the end of a cyclical, very long-term move here on stocks, on the economy. So therefore, I would not be surprised, and sometime in the next few months, that stock market's on all, everything you look at, fundamentally and technically, it is extreme. And the move in the last 12 months has been totally exponential. I have not seen a move like that. For the last 100 years, basically.
I certainly never lived through anything like this, and I've seen a couple bubbles. That's a whole other discussion, but you're right.
Okay, so anyway, so a lot of interesting things are going to happen, but please, as we always say, think about risk. You must think about protecting against risk.